Second. All right, everyone. Welcome to the Virtual Investor. This is Tuesday, February 28th, Mike?
Yep.
So Michael and I are going to do a couple of deal reviews. We're going to go over a couple properties that we recently purchased at auction. I'll give you the timelines, what we did to the properties, if anything, and what our net profits were. Great example of what we do at REO Auction Academy here. I mean, these are typical deals that we get. Some are bigger than others. We wanted to show you an example of the two most recent deals we did. And Mike's going to lead off with the first one in Linton, Indiana. I'm going to hand off to you, Mike.
Thanks, Paul. Yeah. So in this deal review, it was an auction property that we picked up. It was an REO, so the bank already owned it and went through the foreclosure process. And it started out as what they call a first look program that's out there. And these are becoming more and more common. And what first look essentially means is many auction sites use them. And for the first, call it 30 days, this property is only available to owner occupants. So if you're going to bid on it and win it, you have to live in the property or be part of some kind of government entity that's exempt from this. So it wasn't available for us. However, the way our system works, our VA kind of gathers this data and we continue to monitor it each week as it may become available to investors to bid on. And, once it did become available to investors to bid on, that's when we started the analysis process on our end. Another thing here, it's, kind of rural Indiana. It wasn't outside of a major metropolitan area. However, plenty of opportunities in the more rural markets to make a deal.
And that's been our bread and butter, Mike.
Exactly.
So well in these rural markets, and it's really just digging and doing a little research. And look, as long as you can find comps, you got a potential deal.
Yeah. Let's pull up some photos for.
Yep,
Paul, you want to do that?
Yeah, let's do that.
Tab now. It's going to take us to realtor.com. You see that?
See that? Yep.
So the exterior and what you saw in the previous. Another look at it. Gravel driveway. There's stuff there. Looking at it, potential escape work that it needs to be done.
Oh, you froze up there for a sec, Mike.
But these are okay. I think it's back. There's some troubles with the real.com site right now, so I'm just going to.
Yeah, that could be what it is.
Yep, you're back. All right.
Yep, you're back loud and clear. We can just kind of go over without the visuals.
Yeah, it was realtor.com. It was freezing up on it.
Yeah.
Let's do that. So I mean, hopefully you got a taste of it. Exactly. So hopefully you got a taste of it, but if you didn't, it's essentially a dated property, call it late 80s, early 1990 styles, a lot of the rooms, and tenants did leave some stuff. So when we went into this property, we looked at it as maybe some minor clean out renovations, landscape type of work, and then listed on the MLS. So we did our analysis, looked at what some properties were going for. When I was going through my comps the other day to kind of look at our initial analysis of the property, we saw one good comp. It was a property that was worse condition than this one that actually sold for 75 and was a lot worse condition. So we knew we had like a floor on what a property would go for in that area. And then talking to a local agent, we got more and more comfortable with our analysis and the information they provided us. So we ultimately ended up buying this for $74K. And the way we funded the property was with our own funds. So we didn't use a private lender on this one or an asset-based lender. And the investment strategy we looked at was what we call a wholesale. It's essentially minor cosmetic clean out, which is what we did. We did some landscape work, Paul. Yeah. And then I think what were the other things we did? We spent about
washed it a little bit. I think
that's right.
Yeah. And had a cleaner go inside and just clean up everything on the inside.
Yeah. So just to give you a flavor of what the numbers look like, we ultimately, max bid plus closing costs were about 73 and change. We put in about $1,100-$1,200 into the property. That's the renovation that's the landscaping. That's everything else that we just talked about. So we were all in just under 80, and we ended up getting the property under contract for 130. And that netted us a gross profit, or net profit, I should say, of $40,000, which is a 50% return on our money. And this is a holding period of about only 3 months that we had to hold the property. We purchased it in November and sold it in February, so 3 months.
And to give you an idea of the demand, guys, this was a bidding war. We had two different buyers on there. We had a cash buyer, we had a mortgage buyer, and end up getting bid up. I think our listing price was what, 124,
Correct.
123 or something like that.
Yeah, I think it was 124.9 probably.
124.9. It got bid up to 130 cash, as is, no contingencies type of deal, and a quick closing. So it worked out really, really well. So even in these rural markets, they're still hot markets, right? They're still, especially if it's a property that's in demand that you're getting well under market value.
Yeah. Yeah. And it's a great, 3 months use of your money too, 50% return in just 3 months. You analyze that, it's even greater number, obviously.
Yeah. Huge returns. And those are, we call the big ones a whale, right?
Yeah. No need. You see all these TV shows, right, on A&Es and HGTV, whatever else. There's no need to do that full scale rehab. Mm-hmm. And half the time people will probably get the same amount of money, but after 6 to 9 months of work and headache trying to manage a rehab, whereas we just did some minor things to address and, similar profit.
Yep. Yeah, wholetailing is still the way to go right now.
Yeah. Yeah, especially in this market where prices in certain markets are plateauing or slightly going down, and you don't know what home values are going to be. It's harder to predict, 6+ months out from now. A lot easier to predict a few months from now on where they're going to be. So it's another reason why we like this kind of minor renovation strategy.
Totally reduces our holding costs, reduces all these kind of costs, reduces our exposure to longer term interest rates. Hopefully they don't fluctuate too much in a few months. But when you find a cash buyer, also think about it this way: if you're priced where you'll still potentially find a cash buyer, that helps too. Mortgage rates don't become as big a factor.
Correct. You want to go to the next property, Paul?
Yeah, let's hit the next one. I think we got Akron, Ohio, right?
We do. Yeah. So this one's on Roosevelt Drive in Akron, Ohio. And Akron is just south of Cleveland, so Northeast Ohio area. Great area. We've been buying there for years, in and out. And again, no surprise, another REO auction property for us. Yeah. And for this one, we ended up purchasing it around $26,000. Funding, Paul, did you fund this one, or did we have a private lender fund this one?
We actually had a private lender on this one.
Okay. So we used a private lender on this property. Investment strategy, when we looked at it, and this, given the condition of property, needed some work, we just decided to go in as from a wholesale perspective. So we got this one really low and sold it low. And we'll show you some numbers in a second. Again, you hear a continuous theme here. We just don't bid on these blindly. We reach out to a local agent once we get comfortable with our numbers and it's a potential deal, and they kind of verify our numbers or provide additional information for us to make that decision. So that's a key part of the formula.
It's huge. It's almost everything, right? We don't want to do it without verifying what we got. We have that trust but verify thing with our realtors, that they give us numbers. We want to double check those, but vice versa. Like our numbers, we want to verify with them, because a lot of times we find that we're more conservative and we have lower numbers, and they come in and say it's worth more. And we always want to hear that. We still trust our number, but always safe. And this place needed a lot of work. This was, it was a bargain. Needed a lot of work. Let me add this here. Yeah, there we go.
Yeah, it's back up. It's probably need a lot of work, and it was priced appropriately. I think what we did ultimately was we listed it on the MLS for 60. Yeah. And these are the numbers, how it closed, basically. So we originally had it listed for 60, had some activity at that number, but a lot of the numbers were coming in later than that, given the work it needed. So ultimately what the numbers looked like were all in for 27 and change. And for this case, it was a true wholesale for us. We didn't put anything into it. We just bought it and relisted it as is on the MLS. So transfer taxes, closing costs, holding costs. I think we held this property for 2 months, Paul.
2 months.
Yep. Yeah, December to February. So it's a quick in and out deal. And we ended up with a cash buyer at $48,000. And, dollar wise, it might not look big. You only made $12,000 on this property. However, when we're buying it for 27, that's a 40% return on our money in just 2 months.
Yeah.
So just if you have the system set up for volume on these smaller ones, it's easy to make, this is what we call a single in the game, not a home run, but that's still an easy deal in and out in 2 months.
Yeah, we'll take these all day long.
Yeah.
You do a couple of these a month, they add up, and then you get one of the 40K, and we've had some 50Ks and close to 60. So
Yeah, the last deal review, I think we had a few in the high 50s, so that we presented on. So we're showing you a flavor of singles and home runs and everything else in between on these deal reviews.
yeah, absolutely. Yeah, they're pivotal. And you see these numbers here. We ended up at 12K. So, I mean, that's a really good profit on a quick in and out, doing nothing to the property. We're basically, finding deals through arbitrage, right? We're getting them at a much lower price. We know we can sell them for more. We're getting that confirmed from a realtor, from a local boots on the ground person there, because we're not there. We never see these properties. So, I mean, it's just been our method that we've been doing since 2014 together, Mike, here.
Yeah.
And, you get these ones that are smaller. We've had ones that are smaller than this. We've had ones that are much, much larger, obviously. And we'll continue to go over deal reviews because we have a lot in the pipeline that we're working on. And, we have some that are higher price. We have a lot of that are lower price and a lot of those mid-range ones. But concentrate on those 350 ARV and below, I think is our safest number, especially in this market.
Yeah. And you got all the first home time buyers in that price range everywhere too.
Yep. No, absolutely. I'll pull up some articles here.
Sure. I'll stop sharing.
Yeah, I think I just pulled that off there. So let's see what we got here. Let's start with Redfin and a few different things here. So you see year over year. Can you see this, Mike?
I can.
The 21.2% down. I guess prices of homes sold above listing price, which was almost 60% last year at the peak. So big difference there. We're seeing that even with very restricted inventory. There's just with these higher mortgage rates, that's what you're going to get, right? Because you have less buyers out there able to afford those prices going above and beyond that rate. So we're going above and beyond that price point. So most of them are coming in at or around ask or a little bit below or a little bit above, but it's only 21.2 and 17.7% of homes with price drops. So there's quite a bit going on there.
And that makes sense given what we're seeing, because in some markets, when we're working with a new agent, their recommended list price might be something that was at the peak of the market. They haven't adjusted their pricing to like what a realistic today list price would be. And that's probably why you're seeing they might start with that artificially high number from X months ago when we hit the peak. And that's why you're seeing a lot more properties not hitting the listing price as you did in the past.
Yeah. Yeah. And let's go. And this is odd. I love looking at this, the 10 most competitive cities in the US. And sometimes they surprise you, right? Fayetteville is a linear, affordable market. So is Fort Wayne, Indiana. You wouldn't think Nebraska, but Richmond, Virginia is usually always up there. Wichita, Kansas is actually in for two things right now. It's a very competitive market, but it's actually got the highest rate of zombie foreclosures in the country. Zombie foreclosure meaning it's a vacant pre-foreclosure or foreclosure property where there's nobody living in it. I think that rate is around 13.9%. In that market, which is pretty high.
Yeah.
Then you go to Virginia Beach, Anchorage, Alaska, Lincoln, Nebraska, Chesapeake, El Paso, Texas. You get some interesting things there. Actually, one thing I really wanted to go into, and let's see if I find it here. I believe I have it. It's not the heat map. Let's see. Here we go. The heat map. This is one of my favorites. This tells you where everybody is moving. The darker color, this is where people have moved in the past year. So Cheyenne, Wyoming, right? Very surprising.
Scroll down a little bit so we can see the full map. I'm just seeing the bottom part of the U.S.
Okay, let me see. Is that showing any better? Let me see. Let me see what I see here. Oh yeah, I see what you're saying. Okay, let me try that again. Can you see it any better now?
Nah, still just seeing the bottom.
Kind of frozen on there.
Yeah.
All right, it's interesting. I'll just go over it and I'll just kind of hit Florida. Most of those markets are hot, and obviously in Arizona too. Those markets all within the past year. The other ones, Coeur d'Alene, Idaho, which is a great area, and St. George's, Utah, which is a pretty interesting one. So those are the markets where people have moved in the past year. Obviously, everybody knows where everybody's moving from: California, New York, New Jersey, Pennsylvania, other states. But those are the hot ones, the high tax items there. Let's see. Can you see this at all on Trading Economics?
No, I'm just still seeing that Redfin page where it says top 10
Yeah.
areas.
All right, so it's freezing up there. I'm going to stop the share then, since it's doing that. That's odd. Yeah, we could just talk. I got some hot points here to hit, and we'll just kind of talk about them here. So the median home price is $420,320 right now, which is actually up 6% year over year, which is kind of shocking when you think about it, which tells you how much demand there is, because rates were what, 2.753% last year, now 6.4 or whatever they are right now. So very surprising.
Yeah, it is. I mean, pre-COVID, call it 2019, in that market, wasn't the median average home price rate like about 100K less, around 320?
About 100K less, yeah.
Yeah.
We've had astonishing growth since COVID, and probably too quick, more of a hockey stick type thing, but it's going up, but 6% year over year, but that gap it's starting to decline, right? And I think we'll expect to continue that to decline throughout the year, and we'll either be flat nationally on average for a home price appreciation, slightly down in some markets and slightly up in other markets, obviously, right? You're going to have your hot markets, you're going to have your cold markets, and that's just the way it's going to be. But inventory continues to drop. It's at 429,757. It just keeps dropping, and you have demand still, even with higher interest rates. So because of the restricted inventory, this is a basic macro problem we have, Mike, right? You don't have much inventory and you still have demand. Yeah, it's not as hot as it was last year, but you still have demand. So that's keeping the prices afloat and keeping things strong for now. And as long as let's talk about what could affect it, right? Jobs, right? Jobs can affect it. And we're seeing the tech sector get hit. And we've seen areas where tech people live get really hit more recently, in the past 6 months or so, when they started laying off last year. Your Silicon Valley out there in California, Denver, Colorado. You have, what is it in Texas? The big
Austin,
Texas, right? That's been a big hub.
And I think you mentioned this on a previous call, in North Carolina, Raleigh area, the Triangle is pretty tech heavy as well. But
very tech heavy.
I don't know if they've seen the layoffs in that area yet or not.
And luckily for Raleigh, North Carolina, that became a hot market more recently. So not as affected as the other ones, which had run-ups earlier leading up to it. Like Colorado did, or Denver area, like Phoenix has. A lot of people, if you think about it, moved to Arizona when they went virtual. It was a nice, easy place. Or Boise, Idaho. We saw a lot go to Boise, Idaho, right? And that's declining now. That market is starting to decline. And then you have markets in Utah, because a lot of people move there, and around Salt Lake City, and that market, the inventory jumped 9 times last year. So that market is going to continue to be affected and have some negative ramifications this year. But the markets are still in demand. Tennessee, Texas, Florida, the Carolinas, Indiana, and Ohio continue to do well. As a lot of our deals we're doing are in Indiana and Ohio. We just closed on one in Hubbard, Ohio yesterday, which hopefully we'll do a deal review with you guys over the next few months to see how that one goes. What other markets are we really hitting on right now, Mike, that you can recall?
We got a few in Texas as well. Florida's been good for us as well lately. Just thinking of inventory off the top of my head here. I mean, it's some of the Midwest, Texas, and Southeast states essentially is the theme. No different than it's been for a while for us.
Yeah, and we're picking up one. We're closing on one today in Seneca, South Carolina. That's another one we have.
Yeah. We got 2 in Michigan recently, maybe 3.
Yeah. Oh yeah,
we sold a few already. We have a few under contract or purchased already as well in Michigan. Yep. So that's part of that Ohio, Indiana kind of area.
That Midwest, right? That high demand, inexpensive, low income tax states, lower cost of living.
Yep.
And jobs. There's jobs in those markets too. They're good linear markets. So we really, really like those a lot.
Yeah, we still have the rehab in North Carolina. The one you mentioned we're picking up in South Carolina. So, and then, the Newport Richey, Florida is another one. So Southeast, Texas, and those 3 Midwest states that we just mentioned.
Yes. And there's funny thing. I'm going to see if I could screen share this again and tell me if you see this when I pull it up.
Sure.
Let's see which one we got here.
Yeah, you got a RenFed tab open now, what I see on my end.
Yeah, I got to switch it to another one. Yeah, that's what I'm going to have to do. StreamYard is a little bit different, so I'm going to have to highlight the one I want. And actually, the way you do it, it's a little bit separate. So I'm looking at the Fred, the St. Louis Federal Reserve, and they were trying to show. I'm not sure why their data is showing us. They were showing a 9-month inventory of real estate, which we do not have, right? And they're trying to show like 1 million. There's just not that many properties available. I don't know where their data is from. It's from December, but it's completely inaccurate even in December. Again, I don't know where that's from, but I've seen a couple of people, Sean Terry's Flip the Freedom, put that out there and push that we're heading towards a crash. And look, I just don't see it. Still think it's better for you guys to follow like Altos Research, Redfin. They have really good data there. Zillow's got good data. Adams got really, really good data. I don't know what the Federal Reserve is showing there. I have no idea what that is, but it's completely inaccurate. If you see other things on YouTube with people pushing that fear narrative, I don't see the things to be fearful right now. Let's just talk about the state of the market. I'm like, I don't see anything fearful. I see a buying frenzy coming if rates drop back into the 5s again this spring and early summer.
Yeah, you're going to see that push people up. I mean, it's a mental thing, right? 6 to 5 on an interest rate will, increase mortgage applications because it's just that 5 is a mental barrier from 6.
Totally. And it's affordability too, right? So a lot of people probably fall out of that affordability once it goes to 6 and some odd percent. I think we saw last year, what did we lose? 3 million home buyers when the rates dropped from 3 or went from 3.25 to 7.22%.
Yeah, we had a good chart that kind of illustrated as rates decrease on this type of purchase price, what's that do to the buyer pool with every like 50 basis point change in interest rates? So it's a big jump. It
definitely is a big jump, and it just crushes everything affordability wise. And one thing we've talked about, and we talked about in our coaching calls, I think as well too, when those interest rates creep up, we see rents creep up, right? Because they go from buyers to renters.
Yep.
So you have more rental applications going on. When the rates drop, and this happened, a month ago, when the rates were dropping, all of a sudden the rental applications drop and rents start to drop a little. And then the price of real estate goes up a little bit because, you have more people buying. It
tells you a lot of people are on that borderline of affordability, right where the rates are.
Yes.
And in grand scheme of things, they're still historically low interest rate levels.
They really are, because 8% is the national average, or our historical national average here in the US. So go to 8% and we're at 6.3, and we have people whining and complaining because we're so used to cheap money. We're so used to 2.75, 3.5, 4.5%. And I mean,
it's the anchoring effect of the data. It's just a year ago, it was 2-3 handle. And that's what people are thinking of and comparing it to, instead of taking a step back and looking at it from a bigger picture perspective.
And it was also the speed of it, right? We never we never doubled our rates in a calendar year in history in this country. And we did it in 3 months, right? We did it in 3 months because really, I guess they can use the excuse of the war in Ukraine and Russia. But there was other factors too, right? A lot of we have so much inflation right now with everything, and COVID created so much of that inflation with the cost of lumber going up and cost of all these building materials, cost of labor, people being paid to go home. And I think we're still seeing some of the lingering effects of the free cheap money that went out to people, and maybe they're starting to run out now. Maybe that's kind of what's going on, but we got to keep our eye on that, keep our eye on unemployment. If you start seeing big layoffs coming, it's a lagging indicator in real estate. We're not going to see that for 6 months. 3 to 6 months, we'll start seeing that in the data, but we won't see it right away. But know, as an investor, if you're out there buying, you're starting to see some negative things happen. Maybe just be smarter with your buys. What we're doing and what we're teaching our students right now is to lower not your ARV, but lower what you're going for. Instead of the 75% of that ARV, drop it down to 70 or maybe 65%. We're doing that in a lot of markets we're in, Mike. Dropping these. We're just trying to be more conservative with them, overshoot the repairs, the renovations. So that way you have a little bit extra buffer there. Just give yourself, a little bit of a buffer. It's super important in this market because we just don't know what's moving forward. And we don't know if the war ramps up and changes everything, right? We'll see.
And then, if you're going to renovate a house, and nicely renovated houses are bouncing between like 285 and 300 in a certain neighborhood, use a 285 number, be conservative.
Always go low comp, right? Always go low comp.
Yeah.
So right now, Mike and I are looking at, I'm like, all right, 275 is a recent comp here. And that one needed maybe more work than ours. We're safe with that number.
Yeah.
Should be safe because that gives us a little bit of buffer. Or if it's very comparable to yours, maybe just go down to 65, 270. Just give yourself a little bit of a safe margin there, just in case things go, just in case you have to hold a little bit longer because your holding costs add up. All these different things add up. The longer you hold a property, more costs.
Yeah, if you're going to commit to a project and capital and all that stuff, you might as well make a good profit margin. And if that means missing out on a deal or two, so be it. I'd rather not waste 6 months and make a few grand. I'd rather just find a better deal along the way and skip that one.
Totally. And let's talk about what's going on in the foreclosure market, because it's been now 12 straight months of increase in foreclosures, and they're increasing at an increasing rate. Because I think we had a 10% increase in January from December in foreclosures. And that bodes well for us. It doesn't bode well for people, but it's also something to look at with the economy.
Yeah.
But it does bode well for us because it's more inventory. And we're seeing it, Mike. And we're seeing the banks give us better discounts. And we're just getting better deals out there than we were getting a year or two ago.
Yeah.
So it's a good time to jump in. Go ahead.
Yeah. So it's, lenders continue to repossess more and more properties. Just reading a recent Adam report I guess they published it in February. So it'd be for January 23 data. It's continued to, uptick over time. You're going to see some variance year over year based on different things, but the trend line is more and more lenders are repossessing properties. And we're seeing that with the auction inventory, Paul, and even with the opening bids, they're coming down as well. Their pricing is no longer 2021, 2022 pricing. It's coming down to a more realistic in this market that we're in.
Yeah, totally. Because the more they have, these asset managers get pressured by their bosses to get rid of it, get rid of the old stuff. And that's kind of what we concentrate on. The ones that have been out there for a little while, we try to get the low-lying fruit, try to, bid lower. Each time we bid on a property, by the way, we're out there, we're usually going a little bit lower and a little bit lower over time as they reduce their reserve. Unless it makes sense where it's a deal, we know it's a deal. When they lower to reserve, then we just jump right on it.
Yeah. And then if you can start at the beginning of the foreclosure cycle, we're at the end where the lender took it back after sheriff's sale. It's now bank owned. Again, recent data I saw for January 23, foreclosure starts increased monthly year over year as well. And I think 31 of the 50 states. So lenders are starting a foreclosure process, I think, on over 20-some thousand properties in January of 23. And that's up 75% from a year ago. So it's continued to grow. And what that means is not all those properties are going to make it through sheriff's sale and to the bank REO auctions, but a good percentage of them will as well. So you're going to continue to see inventories rise if you go after REO properties.
Yeah. And then when you're targeting properties, look at that heat map that I think it's NAR that shows that where people are going to. Those are the markets you want to really focus on, because those are going to be easier ones to resell in. They're also going to be the more landlord friendly. So you're going to have more options of selling, because when you're selling, you don't want to just sell to just homeowners. You want to also be able to sell to investors if possible. Having multiple exit strategies is really, really important. Yeah. And the markets we kind of push, Mike, are markets that you can do fix and flip. You can do wholesale. You can do buy and hold. You can do owner finance. So we focus on those markets. We kind of steer clear of the other ones. Unless there's a great deal there, we still look at them. If there's a great deal, we'll jump on it. But, there's just focus on the markets that make the most sense for you and make the most sense for your return on investment.
Well said.
All right. Now, if any of you guys want to learn a little bit more, it's reauctionacademy.com. That's where they can learn a little bit more about our coaching program. Mike, do you want to talk a little bit about our different coaching programs?
Yeah. So we have 3 different levels. One is just a monthly $97 a month subscription fee where you have access to our platform. So more private group calls like this, talking about specific deals, specific market updates and trends. We'll bring in guest speakers from the lending perspective to help you fund your deals. We'll bring in attorneys to make sure your assets are properly protected. We had recently an insurance company on for your rehab projects and rental properties. So we have a mix of guest speakers, deal review, and just market trend updates for the smaller group. And then we also have, for those that actually want to learn to bid at online auctions, you have access to everything that I just said, plus our kind of high level course on how to do this and some tools that we use, such as different Google Sheets to, capture all that information you need, how to determine repair costs, how to comp properties, how to talk to different agents in new markets, how to find rehabbers in those markets. So we have a course called REO Auction Academy, kind of do it yourself home study course for $497. And you also have access to that online platform that I talked about as well. And then the last one, this is the more hand-holding one. This is our group coaching program where we, work with individuals more in the weeds, let's just say. So they'll bring a deal to us. We'll help review it with them. We'll set them up with the title companies we use. We'll help them fund the deal. We might fund the deal ourselves and, joint venture with someone if they're not comfortable doing it by themselves. So that's kind of a higher price point. And that's a program that's more geared to someone that actually wants to do it and kind of wants help along the way. And we provide that support.
Yeah. And you know what? We even have a lot of experienced investors. Recently, we just added somebody who has done over 130 deals, and they're in the Florida market and they're in multiple markets now.
Yeah.
They want to learn how to buy this way as well. They're getting tired of the direct to seller, the competition, those costs.
That's a good point. It's a mix of newer people that just want to be more active in their real estate investing, and they might have a day job and they want to do this on the side for supplemental income. We have people that are full-time investors that reach out to us and be part of the program because they want a different acquisition funnel for acquiring leads. They might just buy from wholesalers or directly from agents. They want more deal flow. So they go to the auctions and, work with us. So it's a mix of full-time, part-time people that are in the program.
Yep. And I'm going to hit some of the benefits you get with the full-fledged program, right? This doesn't come with the other two. So what you're going to get with the VIP buyer program, you're going to have bid deposit waivers. And what that is, if you're bidding on whether it's Zome.com or Hubzu, you'll have what's called a bid deposit where they'll put a $2,500 or $3,000 hold on your credit or debit card while you're bidding on that property. We're able to get our students waived. We have agreements with those companies, also with Hudson and Marshall. So you don't have to worry about having bid deposits and capital outlay out. We used to have to deal with that for a long time, and I finally negotiated with them, and they agreed to give it to us and our students because we train our students on exactly how to do it. And they want people who know how to bid. They don't want somebody out there just being a helter-skelter, just bidding and getting the property and then not coming through, right? So you get that. You get access to our national title company who we use, and you get all access to any private lenders we utilize, potentially our funds if you're going to be doing joint ventures with us. And also the national insurance company. Both of these are discounts, right? So you're going to get the title company and the insurance company. They're all discounted. And then we try to get you built up, whether it's with Kiave or Lending One or Dominion or RCN Capital, Lima One Capital, any of these lenders. We're trying to work programs with them where they're going to give a little bit discounted rates our students who have some experience, or if they do joint ventures with us, they get that discounted rate automatically. So those are some of the things you get with working with us. And, they're big benefits, right? They really are on these over the years.
Yeah. And then, the other thing, it's just kind of me and Paul helping you along the way. If you're going to a new market, it could be intimidating your first time. What do I say to an agent? How do I find a contractor? We'll walk you through all that.
Yeah. They would teach you how to be able to try to get the lockbox codes if they're available, how to get your realtor in there, how to get a contractor in there to get your repairs. So, beforehand, hopefully what you're getting into, right?
Yeah.
We don't want you to get into
minimize any risk before you actually buy.
Yes. Yep. All mitigating all those kind of things. So if you guys are interested, feel free to go to those websites, check that out. They'll be in the show notes here, and we will catch you guys on the next broadcast.